The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to Stock Take. My name is Gaurav Sodhi. Joining me today, all the way from Vancouver, is analyst Graham Whitcomb. Hey, Graham.
Hi, Gaurav.
It's been great having you on lately, Graham. I hope it's not keeping up too late or waking up too early.
No, it's 4:30 in the afternoon.
Wow. Oh, well, that's pretty cozy, actually. I have to sit here pretty early. It's 9 a.m. Too early. We're at home, lockdown.
Isn't it 10 a.m.? I think it's 10 a.m.
Oh, geez, look at that. It's 10 a.m.
9:50.
And you may have recognized the voice, but joining us also is Mickey, our analyst, Mickey Mordek. Hey, Mickey.
Hey, Gauravson.
No one's going to understand that joke, Mickey, but let's carry on regardless. Let's begin with Graham. Let's start with Sydney Airport. There was some news about Sydney Airport, some surprising news. Fill us in what happened.
Very big news. The largest takeover offer in history was launched a couple of days ago.
Hang on, is that true in Australian corporate history? That can't be
yeah,
right.
I didn't realize that until I kind of looked into it. But yeah, $30 billion is an enterprise value for Sydney Airport. That takes it to the top spot of proposed takeovers.
Now, what was their previous winner? Do you know?
No, I'm not sure. And it doesn't stand up very well against international ones. There's been some $100 billion ones internationally, but in little Australia, it's the biggest.
And what do we think about it? Well, first of all, I was very surprised. I think we were on a meeting, and then JC just chirped up and said, "Oh, there's been a bid for Sydney Airport," and I was quite shocked by that. I did not expect that at all. Were you surprised, or did you think that was always a possibility?
Yeah, I was quite surprised just by the sheer size of it. You have to have pretty deep pockets to spend that much, especially it's an all-cash offer. However, I mean, it kind of makes sense because there's been, with interest rates so low, there's plenty of pension funds and infrastructure funds that are just hungry for assets. So all kinds of infrastructure assets have been going up in price or getting takeover offers.
Now,
so in that sense, it wasn't too surprising that they would try for Sydney Airport, but I was still caught off guard just because of its size.
Now, but before we get into the details of the bid, that's an interesting point you raised there, Mickelson. Do you? Sorry, that always makes me laugh, Mickey. Do you? I've heard this argument. I guess I kind of made this argument in the past as well, that it's possible that these infrastructure style assets are just permanently mispriced by public markets, and that private investors interested in low risk recurring returns will always pay more for them. And in an environment where they have access to deep pools of cheap capital, they're able to actually pay higher prices than public markets. Do you think that's true across the board? Is this kind of specific to Sydney Airport?
Yeah, well, I mean, that certainly seems to be the case. I guess, like, for a lot of those pension funds or, infrastructure style funds, maybe they have lower return hurdles than
I was
like
thinking that too. Yeah.
some like equity investors. So I guess there's, you can probably make money like buying these assets and hoping that an infrastructure fund comes along and buys it, but you're kind of hoping that someone will, and I guess if no one does, then you're just holding the asset and you get the return of the asset. So I guess it kind of works when we're in this paradigm, but like maybe that paradigm can change at some point, or
As someone who covers a lot of these infrastructure style assets, I got to tell you, valuing these things is now very difficult, because in the great thing about these businesses is that they lend themselves very well to modeling, and I don't like to use modeling often in my valuations. I just think it tends to lead down the wrong way of thinking and often the wrong answer. But in these style of businesses, it's a great way to do things. But the return hurdle is always the sticking point. And if you know that super funds are using a much lower return hurdle than you ordinarily would, do you plug that in and raise the valuation of the asset, or do you stick to your own return hurdle? It's a real, I think that's a point of confusion. I'm not sure there's an easy answer for that, but it is a conundrum. It means we potentially miss out on opportunities, or we end up paying what we think is too much for them.
Or the opposite, which is that you're valuing them correctly, but you're just not able to predict what other people will value them at. There is a difference
But
between...
isn't the correct price what the marginal buyer is prepared to pay? Isn't that the way stock
I don't
markets
know.
work?
It depends on your opportunity cost. If you can get a 15% return elsewhere, then something's worthless to you if it earns less than that and has a higher risk.
I think that one part of the issue is that, like, you know, if you're buying it as a fund or a super fund, then you're buying like the whole thing, and so then you can just lever it up on really low interest rates, and so maybe you're not looking at a cost of, you know, say like an equity investor needs a 10% return, but if you're borrowing, you know, 60% of it at 3%, then you can afford a much lower return and still get a pretty good return on it. So,
and they also have much longer horizons, that these pension funds are buying them for the next 50 years. Normal investors aren't thinking about Sydney Airport as a 50-year investment.
Graham, was that an admission?
To what?
You're not thinking 50 years ahead? You know, JC would be horrified to hear that.
Yeah, I guess that'll put me in my 80s. I don't know. Maybe I'll think about 40 and then I'll just spend it all in my last 10 years.
Now, let's get to the specifics of the deal. So talk to us about who's actually buying the asset, and is it worth that amount of money?
So it's a group of pension and infrastructure funds, as we kind of implied, a couple of Australian ones and some international ones. They've offered $8.25 per share, which puts it at about $22 billion for the equity in Sydney Airport and $30 billion if you add their net debt.
And what's that in terms of per share?
That's $8.25.
Sorry, I might have missed that.
Per share.
Right,
yeah,
$8.25.
So that puts it pretty close to almost as high as it was just prior to the pandemic. So it's an interesting valuation because they're essentially valuing it at the highest price that was ever paid for it before the pandemic, and now we're in a much more uncertain world. So I think that's what they're relying on, is that there's probably an argument that they've put in such a high bid because it means the board will have a lot of difficulty rejecting it. The board's never, and kind of didn't sound very positive on the deal in the actual announcement.
I thought they were quite dismissive, actually, for an offer that is, I would have thought, quite reasonable.
I thought it was kind of funny because they say they haven't formed an opinion, but it seemed like they had very much formed an opinion in the announcement. But I mean, they're probably correct that the funds are being opportunistic going in for it now. In any case, the valuation doesn't look too bad, but we think that there's a bit more to go in terms of its true value, particularly now when the economy is starting, or at least the global economy is starting to recover. Travel is much higher across the board. So they seem past the worst of it, and it's probably only a matter of time before Sydney Airport opens up and enjoys that same boom in passenger numbers.
Now, I wanted to challenge that notion a little bit. I'm the only analyst, I think, who doesn't own Sydney Airport, and I know all you guys jumped on it pretty quickly. I bought Auckland.
I don't own it either.
Oh,
yeah,
okay. Mickey doesn't own it either. I bought Auckland during the pandemic, and I've since sold that. But I don't own any at the moment. And the reason I haven't bought any myself is that I'm not convinced, Graham, that the future returns of Sydney Airport are going to resemble the past, because I don't think the capital structure can be the same as it has been in the past. This has been a business that's spruiked returns with a lot of debt, and I think that's been entirely appropriate because it is a high quality business. It can handle a lot of debt, and they've used that to generate very good returns in the past. I just can't see bankers, regulators, or other stakeholders allowing the business to carry that much debt in the past, having lived through a year where revenues fell by 95%. And
I don't know. I think it depends on when the time frame you're looking at. We know that Sydney Airport has to be handed back to the government in 2097. So in that sense, no, it can't have debt on that last day. So at some point, the capital structure will have to change. But at the same time, at the moment, it's got $7.5 billion or so of net debt. But prior to the pandemic, it was earning more than $1 billion in cash flow each year, free cash flow, distributable. So you could knock off 7 years from the end of the lease, and then so that makes it like a 70-year lease, where you've got no debt essentially. So I think you're right that in the long term it has to change, but there's a long runway before then, that it can keep up this.
I know theoretically it can, but are bankers and management, are they going to be willing to run a business where we've had an example of revenue falling 95%? Because in the past, no one would have thought our revenues would be down 95% one year.
Yeah,
No one would have thought that's a possibility. But now
I
we
think
know
the
that
funding.
possibility exists. I can't imagine they'd be running gearing the assets so heavily.
I think the funding costs might go up a little bit, but where else are the bankers going to put their money? Sydney Airport is still, if anything, you could use this crisis as an example for why it is such a good asset, because we've had 2 years of no revenue basically, and it still has managed to survive, and the debt grew a little bit, but nothing catastrophic. I think it shows its resilience.
One of the things I guess that concerns me, and I don't think anyone knows how it's going to play out, but we've kind of set a precedent now where if we get another pandemic, it maybe
Yeah.
These are kind of going to be like a regular thing where airports our airlines airports going to be shut down for 2 years at a time every decade.
Yeah.
Uh,
I think you're right. That worries me as well. That
At the
this has set
smallest hint,
a strange precedent that means lockdowns are probably, which were previously kind of, you would never have thought that they were possible in big Western economies, but now that cat's out of the bag. So I think they will be used again.
And the smallest in the past. I mean, we've had a lot of new coronaviruses emerge all over the world. There's been SARS and MERS and all of that, and we haven't responded with wholesale, closing of the borders. But you can imagine in the future, the smallest whiff of a new SARS virus or coronavirus, and everything, all the international travel is going to completely stop. Surely, that's going to be the default reaction. So, I don't know. For me, no question, this is a premier asset. I think management's really good, Graham, and I agree that theoretically the business is capable of a lot of debt, but practically, I'd be surprised to see management take on the debt they have in the past. Although I take your point that when I think about it, you're right. Actually, they've just gone through 2 years where revenue's fallen 95%. They're still there, so maybe they might take. Maybe that's the approach they'll take. Might take that to the bankers and say, "Look, we're still around after such a catastrophe." That's quite interesting. I didn't think about that.
And it's just, I mean, I can't imagine a banker turning to almost any other business and being more generous with it. This is an absolute monopoly over the most important gate to Australia. It has ridiculous margins in normal times of like 50% net profit. And yeah, most of the capital cost was paid up front to get the lease and to build the airport itself. So now it just,
I suppose I'm
there is
thinking
no
about.
better asset, I think, in Australia in terms of valuation aside.
I'm thinking about the GFC, and prior to the GFC, we had these what we thought were adequate capital adequacy ratios and Tier 1 capital ratios for banks. And post the GFC, all that changed. And I just think when you get a big external shock, everyone reacts, maybe overreacts to that shock, and you see that happening throughout history. When the first, even go back to the 70s, when the oil crisis, where oil prices jumped, people's behavior permanently changed. And that's when Japanese importers or Japanese exporters, sorry, got going in the US because of the way consumers were so burned by those high oil prices. These sort of big impacts, external impacts, have lingering effects, and I do think it's a possibility that Sydney Airport will be forced to be more conservative in the future. But as you say, that might not even matter. What do you think the chances are of getting the bid up? Do you think this is going to invite other acquirers, or do you think at some point management is going to have to engage? I think the bid's probably good enough for them to have to engage.
Oh yeah, you can bet management are looking into it. Well, it's hard to know what the odds of something higher would be. Um, Yeah. I mean, UniSuper has a large stake in Sydney Airport, 15% or so. So
Mm.
they have a bit of a swing vote over the deal's ability to go through. So it's possible that other super funds or other infrastructure funds are now making proposals to UniSuper to get that on their side. So another offer is possible. I don't think it would come in any higher than this one, really. And the current share price is below the offer price, which suggests that the
I thought
market
that
as
was
a whole
interesting.
thinks that it'll probably not go any higher. There's a small probability it'll go through. Sorry, that it'll fail. It might fail some of the regulatory hurdles because it is such an important asset. There's a whole heap of reviews that need to be done for it to change hands. Also, there's I mean, depending on management's aggressiveness, it doesn't sound like they're very keen on the deal. They could always go to some independent valuer and have the valuer say that Sydney Airport's worth much more than the current offer price as a way to reject it. So there are different levers that could probably be pulled, but it is such an absurdly high offer in terms of total value that they'll probably have a hard time arguing that.
One of the things that's
sorry, go on, Michael.
Oh no, I was just going to say one of the things I guess that's a bit sad about all these offers and things is that you feel like all these good assets are getting just taken off the market, and then what are you going to do?
That's exactly how I felt when I saw it. I was like, Sydney Airport's one of the best in Australia. It deserves to be in the hands of the people. Yeah.
Well,
at the same time, we're getting Tabcorp spitting out the lotteries business, so at least we'll kind of exchange one for another.
All right, just two quick questions, Graham. One, first of all, the real test is what you do with your money. Would you be tempted to sell into this offer, or would you hold on to it?
No, I own Sydney Airport, and I don't intend to sell into the offer at this price anyway.
Ooh, I must say, if I owned it, I would probably be selling into the offer.
Mickey, what about you? Even at the offer price, if you held it for the next 20 years, you're probably going to earn at least an 8 or 9% return.
Yeah.
So unless you think you can do something better with the money,
I think that's the crux of it. Yeah.
I don't think I think it does undervalue Sydney Airport. It's hard to make that claim when it's the largest amount ever paid for a business in Australia, but Sydney Airport's just unreal. I wouldn't want to be selling it.
Love it, Graham. Great conviction. Mickey, how about you? Would you be holding, or would you be selling into the offer?
I don't know. I'd probably be holding. I think I think I'd be holding. I probably have a natural. The problem is, what are you going to put your money into now? It's almost like everything's so expensive, and what are you going to? You're probably going to have some capital gains if you bought it, 5-6 years ago. Well, actually, maybe not. So but this is why Graham's the analyst on this stuff.
And
He's
you're
got
not.
much more interesting things to say about it.
Hey, Graham, while we've got you here, give us a quick couple of words on Tabcorp as well. So I think this is a really interesting development to see Tabcorp announcing a formal split. Humiliating, I think, for previous board and management. It's just such a waste of money. This whole process has been such a waste. But I'm surprised to see the share price fall a bit. Is that in your? I mean, talk to us about that a little bit. Do you think it's a good development or not?
Well, I think it's really good in the sense that it probably made sense from the get-go to have the lotteries business separate to the wagering business. Combining TAT's wagering business with Tabcorp's wagering business made sense. And you can also, in terms of the original merger with TAT's, and until now, management has always had the pitch that it's important to have the lotteries business too, because it's a stable earner and it can offset some of the volatility in the wagering side.
And it pays our salaries.
Exactly. That's what I think the biggest thing is it has always made sense to split lotteries off, really. I don't think those other arguments are very strong. However, what's changed is David Attenborough, the CEO, is now leaving. And so he probably doesn't have that incentive to manage half as much company and then earn a substantially lower wage, he doesn't really care anymore because he's leaving. So, yeah, until now, he's been in favor of keeping the businesses together, probably because I don't know what his motives are, but it certainly supported his wage the whole time, which is tens of millions overall.
Wow, is that right?
In terms of what he's owned cumulatively. I think his
Tens of
annual
millions.
salary is in the millions. I can't remember.
That is extraordinary for when you look at how much value has been lost / created
Yeah.
in Tabcorp compared to how much the managers have taken. That is extraordinary. Wow.
Yeah. Yeah. Anyway, he and the chairman are changing seats now. So with the two separate businesses, I think they'll probably be in a much better position, if only because shareholders can then own each of them independently, value them independently, and you don't get this. I like the Charlie Munger quote: "If you mix raisins with turds, you still have turds." So it was a shame mixing in lotteries with the wagering business, which is very inferior.
That lotteries business may be the best business in Australia, I reckon.
I think it's a contender with Sydney Airport. I'd be happy to own both of them for the next 50 years.
I reckon it's a contender with realestate.com above Sydney Airport for me. Yeah. Mickey, weighing in?
Oh, the lotteries.
You probably say
yeah,
EML. You probably reckon EML is the best business in Australia.
Oh, jeez, yeah,
Knowing
I
you,
reckon it's.
you love that thing.
Yeah, lotteries. Yeah, like it's obviously it's great business. I guess it's just the growth, isn't it? It's just how fast it grows. But it's pretty much a license to print money, isn't it?
It's exactly what it is. Yeah.
And it's getting better and better because now it's able to do a direct to sell directly to the public through its website. That takes out what tiny amounts of capital it did need to reinvest. It doesn't pay the huge commission to the
resellers,
news agents. Like, this was an already phenomenal business, and it's now, over the past few years, transformed, and helped by the pandemic, transformed into an even better one.
Nice one. Well, I expect there'll be more to say about Tabcorp at another stage, especially as we get closer to that split.
Yeah, we'll be printing or publishing an article later this week.
Nice one. Mickey, let's move on along to you, because we hinted about your love affair with EML. Let's explore that.
That's a bit of a love-hate relationship at the moment. But,
I call it infatuation. I do not understand your attention to this business. I must say, so I thought what we do here is I'm going to be the email skeptic. I think a role I play quite easily, and you can convince me about the merits of a business that 4 times in the last 12 months we've woken up and the share price has fallen 30% in in that morning.
It's never been more undervalued.
Well,
before we jump into it, it's a complicated business. People might not be familiar with it. Just give us the basics about how the company works.
Well, so the 40% thing, I think, was it fell in the pandemic, and
regularly.
Yeah, well, but so did a lot of things.
Yeah, no, that's fair.
So I don't think you can hold that against the company. And I also don't think, it also depends. Like, if you think the market's rational, then okay, fair enough. But if you think the market can sometimes be irrational, then who cares what the price is doing, really? So that would be my arguments there. But I think it's also it is a complicated business, and I think when you first come to it, it's sort of a bit nebulous, and so it's a bit hard to kind of get comfortable with it. And it's buying other businesses, and so the financials are quite messy as well. And so I think it is prone to these kinds of ups and downs. But I guess just to give you kind of an overview of what the business does is that it's you'd kind of just describe it as a payments software technology provider. So they pretty much provide like a payments platform, and that platform it facilitates payments, it processes payments, it deals with banks, it deals with underlying card networks like MasterCard and Visa. It can facilitate AML and know your customer protocols, which is part of the issue that they're facing at the moment. So just kind of it's basically a platform, a technology platform for for payments providers. And so what they do is, they're not selling directly to consumers, they're selling to other companies, and companies can essentially come along, plug into the platform, and they build apps on top of that platform. And so what you're seeing is like lots and lots of apps are being built on the EML platform. And so these are apps like sports betting, they are apps like, neo lending, even like the New South Wales transport. The Opal system now is they're doing a pilot with EML. So there's lots of different applications for this as payments become increasingly digital, and so that's kind of what they're doing. So the aim of the game, pretty much for them, is just to build out their platform, offer as much different types of technology that they can, keep innovating, maybe keep buying things to plug into that platform and make it better and better, and then invite business customers to build apps on top of it, basically, and then basically once they've built those apps on top of it, they can, they go off, they market those programs, and EML earns money by, the transactions processed through the platform.
How would they compete against MasterCard and Stripe and the other big payment platforms?
Well, they're not exactly competing. So like MasterCard is a partner. So they partner with MasterCard and Visa, and so MasterCard's not a competitor. MasterCard's more like a supplier. Stripe is just operating in different parts of the payments space. So Stripe is probably more about facilitating cross-border payments for merchants and things like that, among many other things. It is, I guess, it is like quite a broad space, and it's such a rapidly growing space, digital payments, that it's not. I don't think that. I think it's more. They're not there's going to be lots and lots of different niches and lots of different specializations, so they don't necessarily need to kind of compete. And like once you've developed a solution, so say for example, so the classic example is like the gift cards, small gift cards. So this is kind of what their bread and butter was before the pandemic. So they issue gift cards when you go into a Westfield or what have you, or a Simon's Malls now. You get a gift card. They actually issue the card. They store the balance. They process the payments. They make sure it's being spent inside the center. They give the operator like a software interface. And what happens is, I guess, once they develop that niche, then they can invest more in it than their competitors, and they can keep developing that solution. And so basically you just kind of get these providers that end up kind of owning particular niches of payments. And so it's pretty much just about, I guess, developing new niches and new programs and inviting new programs on. And there's a lot of switching costs involved, because once, say for example, these gift cards, you've got thousands of them in the market. If you want to transition providers, it's very, very hard, because you have to, find a new provider, but you also have to transition your current customers onto like a new program or something.
I do agree with that. That's actually probably the best part of the business, is that once you've built a bespoke payment solution for someone, it's very unlikely they're going to switch away from that. But Mickey, can they really scale by building a whole series of specific solutions for specific customers? Is that the same thing as a what's that American business, that one that I really like, the one that Facebook's CEO runs, not Facebook CEO, what am I saying, Twitter CEO
Facebook?
runs.
Twitter CEO?
the one that Twitter CEO
Are you
runs.
talking about Stripe or
No, not it's not Stripe, it's
Square?
Square.
You think
Thank
it's
you.
Square?
Square.
Yeah.
Square. Yeah. So Square can scale beautifully, because it uses one piece of software, and everything runs through that. So the solution is quite scalable. Whereas here, every new customer requires a bespoke piece of software and a whole bunch of specific investment to get that customer up and running.
Well, yeah. So I think that's sort of how it's sort of began, but as they've built out the platform, now it's more about just people building their own apps on top of it. So they pretty much provide like the underlying architecture, and then you come along as a software developer and you can just plug into their APIs, which is essentially just a way for two pieces of software to communicate.
Do you know, Mickey, it took me, I came across APIs when I was researching Tyro. No joke. It took me like a week and a half to understand what the heck an API was. And then you've just explained it in one sentence, just beautifully. That's exactly what it is. Yeah.
I don't really understand coding or developing, but I understand that. I understand that's the purpose of it, I think. So it just means that if you are a company, say you're a lending company, and you want to provide your customers with a card that allows people to go out, spend it, and monitor their purchases, you don't have to necessarily have a person. You might have an account manager at EML, I guess, but you can develop using their software. You can plug directly in. So I think it is quite scalable, and it's definitely scalable in the sense that once they start onboarding customers and that initial maybe development work is done, they can grow their business and you kind of grow with them, and they're the ones that are spending on the marketing and the development and building that business. So
it's a company that's been around for a long time, though. I just wonder why. I mean, it's not exactly a small business, but why has it taken so long for the model to kind of work really well? Is it? I understand they had a name change and new management come through. Was that the change? Were they doing something different previously?
Yeah. So testing my memory here, but so in 2012, it was a different business, and then the board bought a little company called eMerchants, and
I thought eMerchants was the
they
original business, wasn't it?
Well, so before they bought that, they were something else. I can't remember what. And then the board, it's basically a shell company. And then they bought eMerchants, and then they brought in Tom Cregan from, I think it's. I
Look at memory.
remember.
We're a bunch of old men today. This is terrible. I can't remember anyone's name. You can't remember anyone's.
Is it He's vice president at at another payments company, and so he came along, renegotiated some of the main deals, and he sort of built the company up from there.
I must admit, he is genuinely impressive. I've seen him present a few times, and he really understands that business really, really well, and super competent management.
Well, yeah, I mean the share price sort of speaks for itself. I mean, you've seen the share price rise.
Hang on a second. You can't in the one hand say, oh, it doesn't matter what the share price is doing, and on the other hand saying that the share price is a measure of success.
I was hoping I'd get away with it that time, but I mean, if you look, so I can be a bit more nuanced and say maybe over the short term the share price doesn't matter that much, but over the last
share price agrees with me, it matters very much.
That sounds more like it.
Well, over the last 10 years, the share price has risen 30, 40, 50 times. So that's pretty impressive, and I think he's done a great job of building that business. So.
So the reason the share price has gotten smacked, though the most recent reason why the share price has gotten smacked, is because of a deal they made to buy an Irish financial payments business. Why has that suddenly gone sour, and does that change your opinion?
Oh, so why has it gone sour? I mean, so I think in the original release that they made, they mentioned kind of Brexit, and they mentioned changing regulatory domicile. So, it's possible that, they've bought this business and then they've moved some card programs across, and that's, attracted a bit more regulatory attention. We still don't know actually what's happened, and we don't know how serious the complaints are. So there's been
the regulators complaining.
Yeah, so it was the regulators that had issue with some of the controls around the AML procedures of this company that they've bought in Ireland, which was prepaid financial services. So I guess a couple of ways that I'm sort of thinking about it is that when they bought it, there was a couple of regulatory issues that they knew about, and so that maybe they knew that there was maybe a couple of small issues, and probably they figured they could invest and maybe bring it up to scratch, but so there probably have been maybe a couple of things, but these programs also are providing like a valuable service in many ways as well. Like, for example, they're doing government disbursements to people so that they can buy food and so that they can pay for essentials, for example. That's one of the card programs that they have. So I have a bit of a tough time thinking like the regulator's not going to take into account the kind of service that they're also providing. But yeah, so I guess share price has fallen a long way. It's kind of recovered a little bit, but the fact is we just don't know. And if you look at the kind of precedents, like Macquarie came out with a piece of research that kind of looked at the last few times that regulators have looked into. This particular regulator has looked into a financial services business, and the norm is just a fine and some sort of remediatory kind of action. So, but I guess the publicity as well in the meantime does have implications as well, because if you're a new customer, maybe you're second guessing joining up, or if you maybe have increased insurance and legal costs and things like that. So that is a bit unfortunate. I think they've probably just haven't been able to defend themselves, because it's everything's they're not it's all confidential and they're not able to talk about anything. So we'll just have to wait and see. But I think that the sooner they can get this all sorted out, then hopefully they can start to rebuild a bit of confidence. And so that's about it, really. But there's not too much to say. It's sort of a bit of a vacuum of information. But
why is there that lack of information? Is the regulator requiring it?
Well, yeah. So the announcements have just said that the discussions are confidential. So perhaps once the issues are resolved, assuming they are resolved, then they might be able to maybe educate the market a bit on what's actually happened. So I guess it is in these moments though where you kind of go, there's lots of uncertainty, but what's maybe the worst case? And the worst case is, well, something really bad happened to that business, and then, but that's not necessarily going to be like the base case. It's probably going to be, as we've looked at with these precedents, that's sort of your base rate. And your base rate, I guess, is if you look at the past actions that that the regulator has taken, and if you kind of judge based on those base rates, then you would assume that maybe there's going to be a fine and some sort of regulatory action. We don't know for sure, and so there's just some uncertainty that we've got to deal with, which is a bit of a shame, because I think the business was doing really well and it was looking forward to a big year, but hopefully we'll get a resolution pretty soon. So
that's quite tricky, actually. I agree with what you're saying there, Mickey. When you have these kinds of high uncertain environments, people tend to not want to deploy their capital, and it's often a great opportunity, but on the flip side, the outcome is just completely out of your hands, and it's quite difficult to predict. I know you're saying that there's some precedents, and I, in the past, would have actually really latched onto those precedents. But my recent experience with TPG and the ACCC, I just realized that a lot of these institutions are so heavily dependent on individuals inside, and those people change, and the precedents maybe don't mean as much as you might think. It's not really a court of law. So the outcome can be really hard to predict, and maybe all that uncertainty by the market is probably warranted. Maybe it isn't, on a risk-adjusted basis. Maybe it isn't a great opportunity like I would have thought a year or two ago.
Yeah, well, I mean, I guess so. If you considered the worst case, we wrote like an article and just assumed that if it loses all its revenue, well, that really only kind of takes it back to where it was before the acquisition, and that's kind of the market cap at the moment. I mean, it has recovered a little bit, so it's almost all factored in already. And then if it isn't that bad, well, it could be plenty of upside. But
so on a
so yeah,
probability basis, it actually looks okay, you think?
yeah. I mean, well, we've got a hold on it. But I mean, like, for example, if someone didn't have, had a little bit of extra and they're looking, maybe now's not a terrible time to get involved. But
Oh, calm
but
down
yeah,
there. Calm down, Mickey.
I don't.
Now's not a terrible time to get involved. Not the most ringing endorsement.
No, well, it's yeah. So, but
all right, that's going to be our next headline when we write about email. You've heard it here first. Right, Graham, anything else to add? Any questions? Do you own email? Are you interested?
I don't own email, no, and I feel I liked it more before that conversation. I didn't. I'm always very skeptical when management hold back information, even if they claim confidentiality and all the rest of it. I just haven't had many experiences where that ended in my favor.
Yeah. Well,
but it could be. I mean, maybe the regulator has made it confidential. Maybe it's such a sensitive issue or involves specific people that could lead to criminal charges or something. There are reasons that they might be confidential, but I don't know. I just don't like it either. But that's where the opportunity is lots of people don't like it.
Well, I guess the specifics are probably, they maybe can't talk about, but I guess they've mentioned it's to do with AML. I guess it's sort of also at this stage you are kind of betting on management as well, and I guess you kind of it sort of does depend if you back them basically, and if you have been on the journey with them and you think that they can keep on going, and has to be said, management does own a lot of stock as well in the company, so they'll have a very strong vested interest in getting on top of this and doing what it takes to get a resolution and move on. So yeah, I guess
I do
think
a lot of we sometimes forget that a lot of risk can actually be managed with portfolio allocation. I mean, we don't have to put a massive chunk of money into every idea, and that these ideas that are kind of higher risk but higher payoff, that's exactly what small position sizes are for, right? And being unduly pessimistic on every idea, it's an awful way to invest, I think. And I said that as someone who probably used to look down before they looked up, and now I've really stopped that approach. I just don't think it helps. I think the market is a mechanism where optimists do better than pessimists, and if you're going to go in and always say no to everything, you're never going to do well.
Yeah. Well, we do have a weighting limit on the stock as well, and it's 3% at the moment. So definitely, I think within those, that's a perfectly reasonable position sizing, and so.
Well, it's already been a 30 bagger, so another what?
Not since we upgraded it, unfortunately, but
not since then.
Yeah.
Plenty more to go, though, right?
Yeah, exactly. We'll be keen to hopefully hear some good news on that front at some stage, but we'll just have to sit tight. So
now, while we're on the subject of good news, let's turn to Telstra, which released some surprising news, I guess. We've been talking about Telstra for a good 18 months about how it holds some interesting infrastructure assets, how a split of those assets or a sale might generate some value, and now they've gone off and done their first asset sale, and it's a bit of a cracker, really. The price they got. So I was on record as saying that they might get 30 times EBITDA for the tower business, but I assumed that was for the sale of a controlling interest in that business with really attractive contracts written to allow third parties access to it. And I thought that might get them 30 times. In fact, what they've ended up doing is selling a minority stake in the towers business with an exclusive contract for 15 years with options for multiple decades after that. So they've actually changed none of their operations. They've had to give up no operational control. They maintain the entire network integrity, entire network ownership, and network control, sorry, and they still got a 28 times EBITDA for the towers business. I'm really stunned by the price. It just goes back to that point we talked about at the top of the podcast about super funds potentially having lower hurdle rates and being capable of paying sums of money that no other investor would really pay for. I think it's a pretty crazy price. I would never have thought they got that under the terms of the sale. But it values their tower business at about $6 billion, and it means that that Telstra gets $2.8 billion in as a cash injection straight away. And the parties who are buying it are a collection of local super funds led by the Future Fund. So it's a secure, non-threatening, and low-demanding buyer who's bought the minority interest. So it's for Telstra an ideal JV partner. So a really good deal all around for Telstra. But I hear you asking, gentlemen, why was I relatively negative about the sale then? Is that the question that was on your lips?
You beat me to it.
There we go. Yes. All right. Well, the reason why I was a bit disappointed was not really the sale. It's just the signal that the sale sends and the way the company intends to use the proceeds of the sale. So first, let's talk about the proceeds. So $2.8 billion coming in. They've already said that half of the proceeds will be paid as a dividend. So that's 50% gone. The rest they're going to pay off debt. They've got a big chunk of debt being that's due for refinancing, I think at the end of this year or early next year. And so the sum will go towards that. Only $75 million is going to be reinvested into the company. $75 million out of a $2.8 billion transaction. And I just think that little bit of information tells you so much about Telstra. This is a business that's run and geared just to keep that dividend pumping along. And I don't think management has the long-term in the front of its mind. And I don't think they're trying to make the best business they can. They are just trying to get the cash coming through the door to then send it off to shareholders. And there'll be shareholders who really love that. And there's a lot of value in franking credits. And you might think that, well, a business with the capital allocation record of Telstra, which is truly atrocious, I mean, you probably want them to pay out as many dividends as you possibly could. But at the same token, that this is a company with some pretty good quality assets, with a commanding market share, with a fantastic brand. And it's just a shame to think that it's never going to be a great business, and it's never going to be that.
What do you feel that they could do with the? So,
yeah. Look, I don't have any clever ideas, but then again, if you pay me Andy Penn's salary, maybe I'll sit down and come up with a few. I mean, the board and management suck out tens of millions of dollars, and you're telling me the best they can do over this period is just hand the cash back. It reminds me of several mistakes that the company has made over the last 10 years. The first one was when the NBN was first sold. Telstra gained $11 billion as a compensation payment. So the company had $11 billion to allocate to try and change the business around so it wouldn't be so dependent on, it wouldn't miss the earnings from the wholesale monopoly that it had lost. And instead of reinvesting that business or turning that business around or doing something innovative or interesting with it, they just handed all that back to shareholders in unsustainable dividends. It had to be cut in the future anyway. So I think that's a wasted opportunity. And the other wasted opportunity was when Vodafone was going through its struggles a couple of years ago. Basically, all the market share that Vodafone ceded, so their market share went from about 12% down to about 4 or 5%. And all of that went to Telstra. And for a while, Telstra was earning the highest operating margins in the world on its mobile business. And rather than put their foot on the throat of Vodafone, I think they could have crushed Vodafone and turned the local market into a duopoly. They just sat there and collected supernormal payments, paid dividends out to everyone, collected bonuses. That's not the way great businesses react. They don't sitting there earning supernormal profits and not changing anything is just as bad as sitting there and earning lousy margins and not changing anything. I think this is a really lazy business, and it's never going to be a great business. And that's just really dawned on me after this sale. He was
Maybe
an
some of that
opportunity.
government culture.
Well, that's
Like being an
exactly.
ex-government business.
Well, I think that's exactly it, Graham. And I think that really shows you what's important in a business. Businesses are run by individuals. They have resources at their disposal. But, you look at a company like Aussie Broadband, which has just been built out of, a handful of guys running a company in regional Victoria, have grown this fantastic, high-performing business that's agile and doing really interesting things. And then he's Telstra, the exact antithesis of all of that. I did think when the plan for the split was announced, I thought, well, here's an opportunity for Telstra to shed a lot of assets to turn itself into maybe a smaller, nimbler, more customer-centric business, and that mobile business would be the center of that, and it can shed all these assets. And this sale has highlighted that they have no intention of doing that. They're going to maintain majority ownership of most of those assets, and the asset sale is just another sugar hit to get more cash through the door to pay out as dividends. And I am very disappointed with that outcome. I just think, we own Telstra in the portfolios. I think it's been an okay performer for members. They would have made maybe 30% or so on it, which is fine. And we'll make more money out of it, and eventually we'll sell it, and this will be a successful investment. But it's not going to be a compound. It's never going to be a great business. And I think there was a shot that it could have been, and it's not. That's a shame.
Well, they sort of, if those are some of the best assets that they're selling, isn't it?
Yeah,
so,
totally.
And,
that's right.
And so I guess it makes it a lower quality business. So it sort of seems strange that that's sort of the way that management is thinking about the business. I guess I would have been thinking along opposite lines, maybe like you shed the kind of assets where you don't see as much value, I guess. Quality.
I suppose everyone's encouraging them. This deal has been lauded by everyone. Like, all the brokers have upgraded it. Everyone's talking about how clever management is. The share price reacted really strongly on the day it was announced, and everyone's looking at the other asset sales and wondering, how much money they can get. But I just think that asks the wrong question. How much money they can get from an asset sale is a one-off deployment of capital, whereas if they're actually doing some real reform, they could change the business to grow revenues and earnings, which they've not done, by the way, for a good dozen years. So I think you can't really blame management. Investors will get the management that they deserve. If all they demand from a company is give us dividends, then that's what they'll get. And I just think maybe this is our fault as investors for not demanding more from the companies we invest in. And it's hard from a business the size of Telstra. What are we supposed to do? But these big corporate investors, I think they're happy to sit there and take the dividends, and ditto retirees who are just happy to sit there and take the dividends. And no, I guess it's no big deal. We got other companies we can invest in. Indeed, we have invested in, but it's a shame for the business itself.
Does it change your impression of, say, the price guide or anything around it, or?
Yeah, look, I double checked the price guide. I think it's about right. There's a bit of variability in there, so I think I reckon it's probably worth sort of mid fours more so. So there's probably a bit more to go, unless they do something silly. These guys aren't dumb; they're competent. I just think they lack ambition and imagination, and maybe incentive to do something more interesting. But I think the price guide's about right. But if you ask me, what stock do you want to own over 10 years? I was in this industry: Macquarie Telecom, Aussie Broadband, maybe Unity, NextDC. Telstra would not even be on that list. Okay. I reckon, I'm pretty sure within 2 years we would have been done with our dalliance with Telstra, and we'd probably, after that, not look at it for a while. So, I'm sounding bitter, but I am a little bit. I think it's a shame. Right.
So, do you think it was still a good upgrade though at $3?
Well, yeah, I think it was, but it could have been better. This could have been a chance for Telstra to do what other large businesses done overseas. Like IBM or Microsoft or Dell. these used to be thought of as giant, bureaucratic, slow-growing, lumbering giants, and they've turned around and become much better companies. And this could have been an opportunity, and I thought it would have been an opportunity for Telstra to do that, and that it's still possible, but from the early indications and just watching what management has had to say and the way the market has reacted, I don't think that's going to be the case here.
Yeah, yeah. Well, I guess it sort of like reminds me a bit of the banks in the way that they're sort of they sort of do things for the wrong reasons on at sometimes. Like you have the shareholder base, just thinking of the banks where they just demand dividends no matter what. And maybe sometimes it isn't always the best thing, but I guess you kind of have to listen to your shareholders as well. So, do you think that's sort of what's happened here, or?
Yeah, look, I think, my position has really evolved on this. So, what, a little secret. One of the primary things I look for is when I listen to a lot of CEO interviews now, and when the CEO talks about the reason for the business existing is if he mentions it's for shareholders or to generate shareholder returns, I'm very unlikely to invest in that company. What I want to hear, like the correct answer to that question, is why do you exist and what's the purpose of the company? Is to solve a problem, or to satisfy customers. They're the only, I think, acceptable answers. And the actions of Telstra tell you that this is a company that sort of sees its existence as satisfying shareholders. And you might think, well, what's wrong with that? Isn't that what it's there for? And maybe technically and legally that's correct. But, think of the great businesses of the world and any company that really generates long-term returns. And it does that by solving problems and by being customer-centric and helping customers. If you're a customer of Telstra has gone through a 2-year, board-heavy, massive investment. They've imagine how much time has gone into this split, the fees involved in the split, how much attention it's taken. And if you're a customer of Telstra, like, where does that leave you? I'm a customer of Telstra. Like, it means nothing to me. I don't think any customer cares what the structure of the assets is. It means nothing. This is just an engineering exercise.
Yeah, well, I think it's a great insight, though. To that sort of that pattern recognition of, the greatest companies in the world. They're driven by just founders that are, they're looking to solve a big problem. And that's probably not Telstra.
No, it's definitely not Telstra. Yeah, and look, it doesn't even have to be founder led. I mean, there are great companies that just have management, and I think sometimes we make too much of this idea of skin in the game and founder led. These are really important, but we shouldn't make that the exclusive site with which we view companies. I think there's can always be good and bad management, and they can be founders or non-founders. But anyway, okay, glad I got that off my chest, boys. It's been bugging me for a while. Gentlemen, I think we better leave the podcast on that sour note. Hopefully we can talk about something more upbeat next time, like the split of Tabcorp, perhaps, or Graham, I would really like to talk about API, which I think is an idea that has a lot of merit, and I reckon no one has bought it, and it'd be good to talk about it a bit in the future podcast.
Yeah, interesting company.
Mikkelsen, maybe we'll talk about an interesting...
The origins of the sun.
Ooh.
Could talk about that.
Well, we could, but I don't think we will.
Don't know if we have enough time in an episode.
People are probably wondering about. We might have to explain this to people.
On that cliffhanger.
There we go. If you want to understand why Mickey's turned into Mikkelsen, you have to tune in next time.
He's part Japanese.
Graham, thanks for joining us over there in Canada.
Thank you, Gaurav.
And Mikkelsen, thanks very much for your time.
Thank you, Gaurav. Cheers.
And for everyone else, thank you for listening.